So global bond yields are hitting 15-year highs, and borrowing costs are surging across the board. But then, just on a single Monday, we see investors throwing nearly $300 million into spot Bitcoin ETFs.
Yeah, it is a massive disconnect.
Right, so in this deep dive, we were looking at exactly why Bitcoin is defying financial gravity for you, holding its price floor above $64,000 and reaching a 59.3% dominance while facing a macro wall that usually just crushes risk assets.
And, I mean, that macro wall is incredibly steep right now. You are looking at U.S. 30-year Treasury yields spiking back up to 2007 levels.
Which is wild.
Totally. And Japan's borrowing costs are hitting, like, 3%. Plus, you have crude oil crossing $90 a barrel.
Yeah.
Usually, all of this just drains excess fiat liquidity out of the broader markets.
Right, leaving way less capital for digital assets.
Exactly. But Bitcoin is holding this really firm floor. Technically speaking, it does need to decisively break horizontal resistance at 65,518 to keep the structure going.
Or else what, it risks dropping back down.
Yeah, if it fails there, we are probably looking at a drop back down to around 59,930.
Okay, so the macro environment is clearly pulling money out, but Bitcoin's dominance keeps rising. I want to look at the altcoin side for a second because we have these massive token unlocks happening.
Oh, absolutely. The inflation there is severe right now.
Yeah, like projects like Caldera and Lombard are expanding their supply by millions this week. Are we basically seeing a leaky bucket situation? Like, is the capital draining out of these inflating altcoins exactly what is filling Bitcoin's bucket?
I mean, that is precisely the mechanism playing out right now. When that scheduled altcoin supply floods the secondary market, large wallet holders, they see the dilution.
Right, they see the hit coming.
So they rotate that capital directly into Bitcoin. It is basically acting as a sponge for all this capital flight from smaller, inflating crypto networks.
Okay, but even if Bitcoin absorbs all that digital cash, miners are still hitting a massive physical roadblock in the real world.
Yeah, the physical infrastructure squeeze is getting really intense. Like, look at the recent BHP report.
The mining firm, right?
Right, the world's largest mining firm. They just reported that copper actually overtook iron ore as their top profit driver for the first time, hitting $18 billion.
Wow, $18 billion just from copper.
Yeah, and that surge is driven almost entirely by the demand to build out AI data centers and upgrade power grids.
Wait, okay, but if AI companies are hoarding copper to build data centers, how does that actually squeeze a Bitcoin miner? I mean, they just buy ASIC machines, don't they?
Well, sure, but an ASIC machine is basically a paperweight without power.
Fair point.
To expand hash rate, miners have to build or upgrade electrical substations and transformers. And AI is buying up the global supply of copper to do the exact same thing.
Oh, so they're directly competing for the exact same raw material.
Exactly. The cost of that electrical infrastructure has skyrocketed. It is completely changing the business model. I mean, CoinShares even renamed their mining ETF to include digital power.
Oh, I saw that. They require, what, an 80% allocation in companies bridging mining and AI now?
Yeah, mining, AI, and power generation.
So are you saying the actual computing power, like the hash rate, doesn't even matter as much anymore? Are we just valuing Bitcoin miners as glorified power grid holding companies?
I mean, essentially, yes. If you do not have the copper and the grid access locked down, your raw machine count is basically irrelevant to investors now.
That is such a huge shift. And just as the hardware side gets constrained by the physical world, institutional adoption is hitting this rigid wall of legacy accounting.
Oh, the regulatory straitjacket is definitely tightening. Just look at the Treasury's proposed Genius Act rules.
Right. They are going after stablecoins.
Aggressively. They are mandating state or federal licenses to issue payment stablecoins in the U.S. by January 2027. And, maybe even bigger, they are moving to classify token airdrops as formal issuances.
Wait, really? To U.S. residents?
Yeah, which would effectively kill spontaneous token distributions.
Wow. And corporate treasuries are already feeling the pain on the accounting side anyway. Like, look at Sharpling's brutal Q2 earnings.
That was a perfect example of the friction.
Yeah, they generate $11.2 million from Ethereum staking, but GAAP accounting forced them to take this massive $394.3 million non-cash loss on their crypto holdings.
It just completely exposes the risk of running yield-seeking altcoin strategies on a traditional corporate balance sheet.
The legacy system just has no idea how to process it.
Exactly. I mean, this is why you have firms like a 16th Eye actively petitioning the SEC to eliminate outdated regulations like Rule 611.
Right, to allow tokenized securities on blockchains.
Yeah, because right now, those ancient rules basically force decentralized automated market makers to route through off-chain equity exchanges, which makes zero sense.
It makes no sense at all, which means for you, the digital asset market is rapidly tethering to real-world constraints.
Absolutely. The days of operating purely in the cloud are completely over.
Right. Success now depends just as much on securing physical copper and navigating stablecoin licensing as it does on writing good software.
You are bound by material shortages and traditional finance regulations now.
Which leaves you with one final thought to ponder. If AI and Bitcoin are now locked in a zero-sum competition for access to power grids, does the ultimate ceiling for digital assets rely entirely on the physical speed of legacy copper mining?